A $100 billion industry is about to be born in Australia with the introduction of covered bonds. The big banks say it'll mean cheaper loans, but critics beg to differ, claiming it will reduce competition. Here's Philip Lasker.
Emerging from the ruins of the global financial crisis is the latest fashion in fundraising by banks, what's considered a more acceptable way of slicing and dicing risk, the covered bond.
It is an important move towards making sure that Australian banks are able to get reliable and the cheapest money available, and that obviously flows through to what we need to charge customers.
But it's not so obvious to people like credit strategist Mark Bailey.
That's a $100 million question, is will that reduction in funding costs be passed on to the end user, people that are looking for mortgages, the businesses out there, especially the small businesses, in terms of lower rates, and that's not clear at all.
What is clear is the government will introduce legislation allowing covered bonds, an instrument giving investors greater security through bonds backed by a dedicated pool of bank assets. The bondholders are also ranked ahead of depositors if the bank defaults.
They have the claim on the pool of assets first, and then also they have a claim back into the bank if they're not fully recovered.
Most, not all, depositors who might be left out of pocket have the government guarantee to fall back on.
It's currently set to end in October. The government has said that scheme will continue. We don't yet know at what level, but even at much lower levels than $1 million, the vast majority of depositors will be covered.
Credit ratings agency Moody's has a negative outlook on Australia's major banks, but whether the covered bonds issue impacts on the bank's risk profile remains to be seen.
Potentially we need to look at the limit on how much of these institutions are going to issue relative to their overall balance sheet, and also potentially there's the issue of what we call cherry picking, whether they're putting the best assets into the covered bond program and leaving the less quality assets on their balance sheet.
Critics have also questioned the wisdom of fuelling home lending with yet cheaper funding, but some doubt whether the banks will be forced to provide that cheaper funding to borrowers. They say covered bonds will reinforce the dominance of the top-rated Big Four banks at the expense of the smaller players.
Even with the credit enhancements that are structurally available for the covered bond market, they still won't be able to issue AAA covered bonds, which is what really attracts the investors to that asset class in the first place.
It's not necessarily the win-win the government was looking for.